Thank you again for joining, everybody. It's always a delight for us to have take some time with clients, friends of clients, and it's always good to see familiar names and some new names. So thanks for joining us. We value your time. Excited about our conversation today, and we will be conversational, but a couple quick housekeeping things before we get into that. Throughout the course of the presentation and Q&A time towards the end, you can always raise your hand for a question and let us know. We will not be using or able to use either the chat or the Q&A feature. So raise your hand and we can get you queued up to voice on and ask a question throughout the presentation and of course during the Q&A towards the end. So please keep that in mind. For our lineup today, I'm going to turn over to Nick Enzweiler, Senior Advisor with Mercer Partners. We also have, I think on your screen, the far other side, Chad Fall, Advisor, Mercer Partners, and then our guests from Red Cedar and North Square. But I'll turn over to Nick to make introductions and get us going.
Thank you, Don. As you said, so good to be here this morning and to see so many friendly names in attendance today. It's always great to get together to do these market updates. It's our goal every quarter at minimum to get together to provide you with an update in terms of what's going on with the capital markets. We want to, be engaged, educate and empower. That's our initiative when it comes to these events. And we're thrilled today because we have some top-notch speakers lined up, some real experts to dive deep into what's going on into the markets today. We've been wanting to get these guys in front of our clients for quite some time, so we're really thrilled they're able to join us today. And also, we've got a great partner in Isaac Green with us today from North Square Investments. He's been a real help to providing insight and investment strategies for our clients. So really excited to have him with us as well. I'm going to turn it over to Isaac to introduce our featured speakers. But Isaac, thank you so much for your partnership. Thank you for help quarterbacking and bringing all this together today for us. We really appreciate it. So glad you could join us.
Yeah, thanks, Nick. As Nick mentioned, I work for North Square Investments. We are a multi-boutique asset management firm based in Chicago. Our main focus is to partner with firms like Red Cedar Investment Management, John and Brandon, who I'm going to pass the time over to here in just a second, to provide institutional quality asset management to advisors like Mercer Partners and Nick and Chad and Don, and to the end client like yourselves. So today we're going to hit some topics that are probably top of mind as far as inflation and interest rates and what's going on with the economy and the Fed. And, like Don mentioned, we'll make this as interactive as possible. So use the raise your hand button. But I'm going to turn it over to John Cassady, who is the CEO and co-CIO of Red Cedar Investment Management, and Brandon Bajema, who is the co-CIO partnered with John, who run a couple of our strategies to talk about the current environment. So John, Brandon, I'll turn it over to you guys.
All right, great. Thank you, Isaac. Let's just jump right into this here. One thing we like to do here at Red Cedar is, look, we have a few funds, and I think you guys are using some of them, mainly on the fixed income side. But we do like to look at the entire breadth of all capital markets, all asset classes and sectors, just to kind of figure out like what are the markets telling us. I think the market is the greatest thing to tell us, what's going on in the psyche of the average investor. So we take a look at this. We do a lot of exercises as a firm where we, rate different assets in terms of whether we like them or not, to have a view into capital flows around the globe. But real quickly, no secret here. Far left-hand side, the green shaded bars are equity market returns. Darker green is year to date. Lighter green is quarter to date through the third quarter. As you can see, and no secret, everyone knows the equity market has been on a tear. It's been nothing but, except for a little minor blip for about a week in April, it's been pretty much a one-way risk on kind of trade. But I do think a couple things to point out here that are interesting is maybe there is a rotation beginning to get underway. The U.S. exceptionalism and the mega cap big tech, they're still doing well. I don't mean to suggest otherwise. You can look at the NASDAQ up 11% for the quarter, but you can look at, the Russell 2000, small caps catching a bid. Maybe that's on the heels of the Fed cutting rates or the prospect of rate cuts, and even EM catching a bid, 11% up. And so the fact that other markets are really keeping up somewhat with the U.S. equity market, this is a rotation that we've kind of expected as a result of the trade wars and going to maybe a bipolar world. Investors, maybe the big European pensions, just maybe in the beginning innings of maybe repatriating some capital and taking it home to spend on some things that they will have to spend on, i.e. defense spending, buying more European debt issuance, that sort of thing. So those are things we have our eyes on. Middle section there, fixed income. It's been a rocky ride for fixed income, where we'll show you a chart here in a second. But, fixed income has done pretty well year to date, up 6% for the broad Bloomberg Ag. And then global ex-US dollar really doing well. The thing that really has us, maybe not, I don't know if worried is the right word, but high yields at what, all-time tights pretty much.
Credit spreads across the piece are absolutely at all-time tights. So you got to be careful because there's not much room for upside in that kind of an environment, and a lot of room for downside.
Yeah. So something we have our eye on. That being said, obviously high yields done well year to date. Then moving over to the gray area, this is what we call our alternatives. Not exactly private equity, private credit, but I feel like commodities used to be the old standby when you talked about alternatives, and now it's interesting because that's coming back into vogue again. And I think there's definitely themes to play there. But you can see energy continuing to struggle. Despite unrest in the Middle East, and this was before the peace deal got brokered and everything. But you would have thought that what we've endured for 2 years with Gaza, and bombing at one of our close allies over in Doha, where the Israelis bombed, I guess allegedly Hamas people there, that would have gotten oil maybe up, maybe into the 70s or so. But
what this is really telling us is that if there's a, sort of a geopolitical premium in oil, the recession fears are overwhelming that. And obviously OPEC also increased supply as well, which obviously does not bode well for the price of oil. But that just jumps off the screen here. Obviously gold does as well.
Yeah.
But the oil being down really jumps off the screen.
And how much Russian oil is getting into the market? Look, they're trying to fund a war that has not exactly gone their way or has taken longer than everyone would have thought.
It would seem that those sanctions have not really bitten at all on the oil side for Russia.
Yeah.
And the rally in gold, which is the other thing that jumps off the page here, is continued, right? So we're 2 weeks into the fourth quarter. That rally has, if anything, has intensified in the last couple of weeks.
Yeah, absolutely. All precious metals, industrial metals, all of the above, right? So you're starting to see that, and for good reason there. But let's talk about bonds. Look, we're just saying the 4 decades of a bond one-way bull market trade is over. Does not mean that you don't own bonds. It's just that maybe that you might have to really think about it, and you have to have a manager who is an expert in managing what's going on in the world to be at your side to manage this. You go back to 1980. You look at that orange line, 10-year yield to maturity, almost a straight line down. Bond returns, I can only count pre-COVID only 3 negative years in bonds. So it was one of those things that, probably a monkey could have done it, as much as I hate to say that because I've spent my career doing it. But it was wind at your back kind of thing.
And some of those returns are eye-popping back in the 80s.
Absolutely.
For a fixed income, was it the ag return here to return over 30% in 1 year? And there's a couple other ones that are, above 20 or close to 20.
Yeah, definitely. Look, we think the stake in the ground that we're putting in is pre-COVID versus post-COVID. This is a whole new world. We had our experiment. Maybe we're not done with modern monetary theory, but definitely governments running deficits seems to be the operative word now. And you can see what happened in the post-COVID world. Yields start to go up. And by the way, the last 10, 15 years were not the norm. You can look through, all the tombs, the volumes that have been produced on a history of interest rates around the world. That 10, 15-year time period where we had negative real yields and zero interest rates, and over in Europe, negative nominal interest rates, that is unheard of. And so for those people who cut their teeth in this business in the past 10 or 15 years and think that that's the norm, no, that was a blip in time. And now you can see the volatility of returns starting in 2021, a couple of back-to-back negative years, which we've never experienced. 2022, the worst year ever in fixed income. But then we bounce back. And we get to, above 5% returns in 2023, a little bit
And
positive.
2025 is not on here. And it's pretty solid.
Positive.
Pretty solid. We just showed it on the screen prior to that. But what's not shown on this graph, which I think is really interesting, is historically there's been different periods of time where the correlation between bonds and equities has moved around. So most of us, pretty much the entire history here that John's talking about, we had a negative correlation where, if equity prices went down, your bond prices went up. That, very famously changed in 2022, where your bond allocation did not help you out because the correlation has turned positive. Now, it's, the future is uncertain. So we don't know if that correlation is going to be, positive for the next 10 or 15 years, or if we're going to go back. But you do have to worry about that now going forward after you had a solid, 15, 20 years.
Yeah. And
very, very negative correlation.
Yeah. And I'd say that solid couple of decades of negative correlations, one thing you could say about that time period is that everyone trusted and believed in the Fed. Inflation was under control.
And that narrative is very much changed.
And that narrative is changing right now. And you look in times historically when we've had high inflation or high inflation expectations, that's when the correlations turn positive, and that's what we're starting to be a little bit concerned about now. Look, this is the Bloomberg Ag, the Global Aggregate Treasuries Index. This just shows you the par amount outstanding pre-COVID, going back to 2014. It was growing at 5.7% CAGR rate annualized. That's how much debt was growing.
Which was already a high rate.
Which was exactly already a high rate. Then you get to the post-COVID world, all of a sudden it's 7.7, 7.8% growth rate. I think this is going to continue. We do a lot of time. We spend a lot of time here focused on geopolitics. We know what's going on with the MAGA agenda, making the Europeans pay for their defense. They're talking about over in Europe now, European countries are going to spend 5% of GDP on defense going forward. The Germans have taken off the debt brake now. So they're going to start spending like drunken sailors, I guess, which we've been doing for a while here. But I think, there's a chance that this growth rate we've experienced of almost 8% could accelerate if the market will allow it, right? That's the big question. And you can see 30-year sovereign debt doesn't matter. You look at the US, UK, Japan, France, we're all spending like drunken sailors, or what did you say the other day about drunken sailors might spend
like central bankers or government bureaucrats. That's right.
So maybe that's the analogy to make here. But just 30-year yields has the most interest rate risk, and you can see the market does not like it. Japan, all of a sudden, they're with their new prime minister talking about fiscal stimulus. France can't seem to keep a government together, although it's now the guy who resigned is now back in.
I can't keep up. They've changed governments. I think it was something like 7 times in the last 5 years and 3 times in the last 3 months. So it's very hard to keep up on exactly what's going there, other than the fact that it's complete chaos.
It is chaos. But you can see it doesn't matter where you are. And here's the thing. You can sit here and say, you can look at US inflation and their fiscal situation by itself, but we're all competing to issue debt globally. And so if all these other guys are going to be spending like crazy, issuing debt. We're in competition for that. And I think that's what you see the market starting to sniff that out and thinking, hang on here a second, we don't really like this. By the way, you'd have to go back to I believe it's 1997 when the UK had rates that were approaching 6% for their 30-year gilt yields. So the thing to keep in mind though is that don't just sit here and look at the US and think they have debt problems. You have to look at the entire globe. It's a global investment marketplace, and people are going to put their money where they think they're getting treated the best by the government authorities and the central bankers.
John, let me
Yeah.
ask you real quick. Let me jump in because you've gone over a lot of great stuff, and I just want to remind everyone if they do have a question, please raise your hand. Happy to take questions too. But when you go back to that debt chart, does it concern you as somebody who manages money for a living, as a professional money manager, the level of debt that we have in this country? I mean, I think it's $37 trillion right now is the national debt. And it looks like it's continuing to compound and grow at an extraordinary rate. I mean, is that something that you think could potentially weigh on risk assets as we go forward?
Yeah, I mean, look, risky assets are all kind of predicated, no matter what, academic theories you subscribe to, but there is that idea about the risk-free rate. Look, there was no risk-free rate for the past, prior to 2020. It was all government medicated, zero interest rates. Now, all of a sudden, I think this is where, yes, it concerns me, but we should become accustomed to understanding what the risk-free rate is and how to price other risky assets accordingly. There's other tricks up their sleeve. Like, look, if my calculation is correct, US is like 120 debt to GDP. Japan is like 250%. Now, Japan is relatively self-funding, right? I mean, the old thing about Mrs. Watanabe controls the household strings and buys bonds or buys equities or whatever. Traditionally, they've kind of funded themselves. You could see maybe there's more QE in the future. Maybe the Fed monetizes the debt. Those are all things we have to think about. And what does that mean for inflation and economic growth going forward?
But if you marry that with the next slide, which shows, these yields going up, I mean, this is bad for past returns, but it's good for future returns, right? Because we don't know where these yields are going to go. Now, obviously, if they continue on their current trajectory, then you're going to lose a lot of money. However, that's really not the way things work in markets, right? We don't have linear moves, straight up or straight down. So the fact that they've moved up in the recent past, bodes well for future returns, all else equal, which it never is. And then people like you and I need to make decisions to say, all right, would I rather, take a 5 or 6% yield on a treasury than risk? And we've got some slides later on equities and the valuations there. So it's always a relative game that you've got to be weighing out in your mind.
So I think for right now, just to tell you what we like, I mean, I think it depends on what part of the yield curve you're invested in. We happen to like that. We were very heavily, overweight the 2 to 5 year part of the yield curve, just because we don't agree with what the Fed's doing and cutting rates necessarily, but
it doesn't matter what we agree with.
It matters
what we think is going to happen.
Yeah, exactly. And we've subsequently moved a little bit further out the curve, maybe 5 to 7 years, just getting that carry, that roll down.
Roll is something the market hasn't really had, for a very long time. Because even after rates started going up in 2022, the curve was inverted. So you didn't really get paid to, at least in yield terms, to go out on the curve. Now you do. Now I do suspect that curve could steepen up even further. But it does pay you now to move out the curve to a degree.
And just to be clear, the 30-year still does frighten me due to.
Yes, we are not buying 30-year paper. That's for sure.
Yeah. And look, we're competing with all these other sovereign nations to issue debt going forward. And we are in essence dependent upon the kindness of strangers to buy our debt. And I guess the big thing, U.S. Treasuries, 30% of total U.S. Treasuries are owned by foreigners, and just, we've started to see that wane somewhat, and really, especially in the aftermath, accelerating after 2022 when we confiscated assets of the Russian government, of the Russian oligarchs. Now, we can say that, what Putin did was horrible and whatever. It doesn't matter what we think. However, maybe it was justified to confiscate, maybe not. But if you're Saudi Arabia, if you're Japan, if you're India, you're probably asking yourself, wow, if I do something the Americans don't like, am I next? Or are my assets getting confiscated? So we think this is a very risky proposition to be dependent on so much of our issuance from foreigners. Look, inflation's still not under control. You guys are probably all aware of this, but look, no matter how you slice it, headline CPI, core CPI, or the Fed's favorite measure, core PCE, we're right about 3%. Really, we really haven't made meaningful progress down from 3%. They are above their target, yet they are cutting. I think this is the Fed basically say it's this fiscal dominance. They have this mission creep where they think that part of their job is to, obviously there's full employment and price stability. You had Stephen Mirren in his confirmation hearing. All of a sudden he trotted out lower long-term rates is now evidently a new
yeah, and then that was always in the I guess it was the Federal Reserve Act. It was always right there staring at everybody. But the fact that he's out there talking about it, I mean, when I hear moderate long-term interest rates from the probably the most important member of the Fed at this point, I'm thinking yield curve control.
Chairman of the FOMC.
Yes, he could potentially be, or he could end up back in the Trump administration in 3 months. It's really a wild card. But I do think we're paying a lot of attention to what he's specifically saying, given that the Trump administration, the next person the Trump administration places on that Fed is probably going to look a lot like Steve Myron.
Yeah, so the fact that we're cutting and they're not going to say it out loud, they're not going to come out and announce, hey, our new target 3 is the new 2. Yeah. But pay attention to what they do, not what they say, I guess is what I would say. Look, they're hiding behind this facade, if you will, that, the labor market's weakening. We got to do something. And you can see here, this is change in non-farm payroll. That red line there, that's like 75,000. That was thought of as that's the amount of jobs you need to create every month to kind of absorb new workers into the workforce and kind of keep unemployment at equilibrium. And then you can see the last 3 or 4 prints have been pretty abysmal. And then I guess even the revisions have been really, really disturbing. However,
but even the unrevised numbers for the most recent couple of quarters or months have not been great.
Let's just go to that. I mean, this is real quick, just kind of showing you what was initially reported versus what was ultimately revised downward. So that's disturbing in and of itself. We've long questioned numbers about, whatever comes out of the government. I do, BLS, I know Trump fired the old person, put a new person in, but now they are not going.
The new person couldn't get confirmed. My
yeah.
understanding. So I'm not sure that we're going to have better government data anytime soon.
So I think we're in agreement that with maybe the Trump administration on that BLS is, not doing a really good job. I think we're in disagreement or in agreement with them for a different reason than them. They want to show a robust economy, right? I mean, that's their whole MO. I'm saying, for a long time now, I think their numbers have been suspect. But with immigration policy, what it is now, how many people that have, I think the estimates are, in the millions of people that have self-deported, right? That have left
negative
migration, yes.
Yeah. So how many jobs does the economy really need to be producing to keep the market healthy? We think that number has materially downshifted.
We think it might be maybe flat to 10 or 20,000, which is right in line with kind of these prints here that we saw.
And that's why you're not seeing the unemployment rate skyrocket. You're not seeing, whatever it is, claims go, and a lot of people get laid off. You're not seeing those kinds of things, which would be those would be the real signs of a weakening labor market. Now, this isn't great, but it's not making me think. There's a lot of reasons for me to think we might have a recession coming up. This really isn't it.
So against that backdrop, sticky inflation. And what we're saying is really the jobs market has not cratered yet. And this shows you CPI, those dots there, the CPI prints going back all the way to 2020, and then the Fed funds rate. You're cutting despite the fact that we're still hovering around 3-ish% inflation. So I think there's more at work here, and it goes back to, if you're familiar with the term fiscal dominance, the idea that the Fed exists so that the government could fund these deficits moving forward. And, somehow, some way, they're going to get interest rates down, and we'll see where that goes. But that could be part of their plan. We shall see.
2 more priced in this year. I think there's even 2 more the next year priced in.
Yeah, that is right. Oh, good point. Yeah, I should point out the October meeting in December, another 25 basis points.
And then more in 26 is what's priced.
Yeah. And look, on top of that, this is kind of like we took a little bit of creative license here. We do think that 2026 will be the year of the dove. I don't know if that's official in the Chinese
It
New
is
Year.
official, yeah.
It's the year of the dove. But look, the regional bank presidents rotate in and out as voters, whereas the governors, the people on the board of governors, they have a permanent position. So you can see here, just look at the tally at the bottom for 2025. We said, we have to look at this like the Supreme Court now, I suppose. Like with maybe the neutral, they're the constitutional, they're constructionists when it comes to the Constitution, and they might be data dependent. And then the doves and hawks might be your liberals or conservatives, depending on how you want to look at it. But now we're sitting here counting up votes on the FOMC as if we're looking at the Supreme Court. The interesting thing, though, is that TBD up there, that is now Stephen Miron, or Myron. I'm not sure. I've heard it pronounced both ways. But he's actually definitely, he's in place here already in 2025, replacing Adriana Kugler, who resigned. She was a hawk, he's a dove. So, that's one in the hawk column. And then all the rotating members coming in from the various board presidents, they are decidedly doves. So we think the makeup for 2026 is clearly dovish, and we think that's where they're going to
And if you see here, Lisa Cook is up here as a dove. So she's obviously all over the news. It doesn't look like the Trump administration is going to be able to replace her, but she's a dove. Now, she's definitely not a loyalist to the Trump campaign or Trump administration in any way, shape, or form, but she should have a dovish tilt.
All right, so now we'll get to tariffs. It's interesting because, if you sit there like we do in front of Bloomberg all day long or Bloomberg TV, we were told time and time again how horrible the economy was. The wheels were falling off imminently. The stock market was going to continue its downward spiral after the Liberation Day. But really, stocks have rebounded. All that being said, though, this is the United States International Trade Commission, an estimate of tariffs. This is through June. I know that has ticked up closer to 10%, but that's where we are right now. It is adding 10%, to the cost of things here in the U.S. Some other estimates of this probably have this closer to 15, 18%. So what's going on? Why have we not seen this flow through quite yet? And we think that there's still the chance that it will.
If you just go back actually, no, you're right. We can talk about this too. Everyone kept thinking, oh, it's going to hit the consumers right now, like immediately. And that might still happen with a delay. But what we are seeing right now is some severe stress within certain corporations in the auto parts supply chain in particular. You had the First Brands bankruptcy and Tricolor. Now, both of them have a plethora of factors that are causing them, most notably fraud. But they are tied to the auto sector, and the auto sector is one of those sectors that's, one of the most, if not the most, impacted by these types of policies.
Yeah.
So even if it doesn't show up in the consumer or CPI, we are starting to see it on some of the balance sheets of some of these more levered entities.
Yeah, and so this analysis by Jan Hatzius at Goldman Sachs, through June, he said that businesses were just taking it on the chin in terms of profit margins. There was a little bit of a degradation in profit margins. I should have put a graph in here with that, but you can see a little bit of a 20 basis point compression in margins across broad S&P 500 companies, not all companies, obviously, but they were just kind of swallowing it in the meantime. He thinks that's going to shift once these tariffs have been in effect. By the time we get to the end of this month, October, that it's going to be more borne by the consumer. So we shall see on that. That can act as an inflationary impulse as well as a
I do
slowing
think
of the
with the
economy.
third quarter earnings, just the season basically starting today, I would look for more U.S. businesses to start to show some cracks here, right? Because they're the ones, as you can see here, according to Goldman Sachs, right? They're footing 2/3 of the bill at this moment. And this is not a small bill, right? Somewhere to the tune of $350 billion. And some of these entities are very levered, which is why we saw what we saw with First Brands.
Some of them had more leverage than most otherwise thought.
That's right. Some of them had 3 times as much
Maybe a little
leverage as they
fraud.
reported.
Yeah.
John,
Yeah.
I have a question, John, Brandon, for you guys on the tariffs. So I've heard two different kind of competing theories about this, and I'd be curious to get your take on it. Obviously tariffs can be inflationary in the sense that, the prices get passed on to the consumer, prices go up, right? Because, of the tariff itself is like a tax. But I've also heard some very smart economists say that it could potentially be deflationary because it could potentially kind of just be demand destructive, right? People aren't going to buy as much if prices are higher, right? So what are your thoughts on that? Do you think that, tariffs are inflationary or deflationary?
Look, I'll be like the two-armed economist here and say the answer is it depends. And look, right now, I think the consumer is in okay shape. It is certainly not. It depends on how the consumer is faring. And right now, we are, despite I think Jamie Dimon gave his comments today saying the consumer's okay, but we are starting to see upticks in delinquencies, more credit card debt. So to me, that shows signs of the consumer beginning to become stressed. In that environment, I think it can be, demand destructive and thereby more deflationary. If that
kind of feels
continues.
stagflationary to me.
It does, yeah.
And I think, the story is going to unfold out in front of our eyes, obviously, right? So if we get more and more bankruptcies like we just saw over the last few weeks, we get those kinds of things, those are going to be deflationary. But if you end up putting 100% tariffs on Chinese goods, which is effectively a trade embargo with our largest or one of the largest trading partners, that's going to be inflationary, at least in the short term. Now it could end up, killing more businesses that end up being more deflationary. And then there's, 100 other factors that are all stirred into that pot. So it's really hard to answer that question. I mean, it seems basic, right? Is it inflationary or is it deflationary? But anything with a dynamic economy like this, and we're talking about all these different countries and factors going into it, it's really hard to tell.
One thing we do know, if you go back to the first Trump administration, when he put the tariffs on China, clearly not as many as are in place now, but by and large, the currency absorbed a lot of those tariff increases, so it was almost unnoticeable to the U.S. consumer.
It was sort of, it felt kind of deflationary.
Yeah, because the U.S. dollar strengthened, right?
Yeah.
But
this
right
time
now,
around, it did not.
This time, famous last words,
great.
This time is different, right? Dollar weakness. So this means that the exporting nation's currency is not absorbing it at this point. So I think that's something you also have to consider.
And one more historical thing to think about when you think about, are they inflationary or are they deflationary? Everyone always talks about, and I think that this narrative is slightly off, but everyone talks about the Smoot-Hawley tariffs back in, what was it, 1931 or 32, contributing to the Great Depression. Well, that was a deflationary event. Now I think Smoot-Hawley has probably played up a little too much in terms of its impact on what happened back in the 30s, but everyone sort of agrees it didn't help. And that was a deflationary bust, not an inflationary boom.
And I think the reason for that, honestly, is because of Ben Stein's appearance in Ferris Bueller's Day Off.
Of course, yeah.
Where he told us that Smoot-Hawley caused the Great Depression.
He did.
All right. So economic growth, this is ancient history at this point. First quarter bad, second quarter 3.8%, recently revised upward to 3.8%, I should say. Atlanta GDP now, I think, is showing 3.4, 3.5% for third quarter. However, that will not be updated going forward, I don't believe, thanks to the government shutdown. So we will never know what GDP now thinks for third quarter. Now, here's the reason, though, for it. Look, U.S. importers or, manufacturing, a lot of people in the U.S. front ran bringing a bunch of imports into the country during first quarter to get ahead of the tariffs. And you can see there that blue line that it was really a mathematical identity, C plus I plus G plus NX equals your GDP. With that net exports, that's off the charts crazy. It subtracted, almost 5 percentage points from GDP during that first quarter. Then you can see it kind of normalized. We didn't import anything in second quarter, so it kind of got back to normal. So we'll see where this goes on an ongoing basis going forward. I will say one thing we are noticing about the components here is that the consumer, consumer spending, based on what we're seeing now and forward-looking data, the consumer is not really they're doing okay, but they're not really growing and really driving positive GDP growth. It's really a lot of CapEx, thanks to AI and software and other initiatives. They're really starting to pick up the baton on GDP. So that's something we're keeping an eye on going forward when we do get the next GDP prints.
And one real interesting tidbit here, I'm not sure how exactly this fits into the broader narrative, but of those net exports where everyone was front running because people knew Liberation Day was coming, right? Two of the biggest contributors to that were actually gold and pharmaceuticals, neither one of which is going to have material tariffs on them. They're both more or less exempted from it. So everyone front ran it or at least the pharmaceutical supply chain front ran it, as did, remember the Comex deliveries, right?
Yeah.
The gold deliveries were sky high too. And it looks as if neither one of those is ultimately going to have material tariffs on it. So I don't know exactly if that changes the narrative here, but I think it's pretty interesting that those people that were front running this aren't even exposed to the tariffs.
Right. Now, look, going back to, Nick, I think you were asking, is it inflationary, deflationary, what? And the answer was, it depends. Look, there is some stimulus coming, right? And this is the one big beautiful bill. These are estimated federal tax refunds that the consumer will get in 2026. It's going to be $150 billion to the consumer in terms of tax refunds over and above what they received in 2025. So that will certainly be a little bit of stimulus in the pipeline. The other piece of it is the fiscal stimulus from the Senate tax bill. And this is excluding tariffs, all that kind of thing. But as a percent of GDP, we already got stimulus to the tune of 0.4% in 2025, thanks to the one big beautiful bill. And that's a little bit different this time around. That usually fiscal stimulus takes time to work, but in this case, the amount of taxes that companies did not have to pay with their September 15th tax payment is actually stimulative because of that. But you can see it really kicks into high gear in 2026. So there's stimulus. The government is here to come to the rescue.
And back to Nick's question, which is basic but profound, I think, is it inflationary and deflationary? We're talking about a tax cut here being stimulative, and tariffs are a tax. So in that context, you would think that they would be deflationary, right? Because it is a tax. It's just a matter of, the real debate's not whether or not it's a tax, it's just who pays it.
Right.
So that's another thing on that deflationary side.
And just, to round things out on this discussion, these are the number of companies that actually cited the one big beautiful bill benefits on their second quarter earnings calls. It's not even close. They were all touting it. Corporate America, for their part, thinks this is like, one of the biggest benefits of the Trump agenda going forward. So let's talk stocks for a little bit. Just like, look, we can all sit here and, we know what's been driving the stock market. There's 7 stock, well, maybe 6, maybe Tesla's been a laggard lately. But
they're no longer in the Mag 7.
That's a good question. That's a great question.
I thought they were calling it the Magnificent 10 now.
Yeah.
Are you serious? I haven't heard
The
that.
S&P 490, and then the top 10.
Okay. Who are the other three that have joined the seven then?
This is as good. Your guess is as good as mine.
Newmont Mining.
Yeah, I don't think so, but that would be funny.
All right, so just this is just kind of a history, a look back of like looking at ranking by PE ratio, the largest companies share in the S&P 500, and you can just see like the last handful of years, it's Apple, Nvidia, that sort of thing, and they are a disproportionate part of the S&P 500. So you as asset allocators, you've been entrusted with your clients' money, and you're sitting here making, I'm not sure how you look at it, but if you just kind of blindly invest in the S&P 500, you're taking huge concentration in, a handful of stocks to the tune of 33% or so. We think that that's going to change. And like, look, we're not going to sit here and tell you, and this, valuations are not a good tool for market timing. But when you take into account everything that's going on around the world, maybe some repatriation, if you think about it, going into European stocks, that's more of a value play, more industrials, that kind of thing. And people just might start to take a look at, what, this might be out over its skis a little bit. By the way, we're kind of keeping China from buying the chips they need from Nvidia to make their economy hum. So now China is starting to develop that internally. They will succeed. They will start to close the gap. And what we know about China is when they do that, they put their mind to it and they get it done pretty quickly. What's it do for the rest of the world? It really puts pressure on margins. So, and look, no one ever thought that Nvidia was going to sit here and continue forward with 60% profit margins. We know that's unsustainable, but we're actually doing our best as government policy to kind of give China a reason to get involved here and develop their own and drive profit margins down. So once again, we don't believe in this to time the market, but it is quite breathtaking how far out they've gotten. Last chart I have here on stocks, once again, not a great market timing tool, but this shows you here the current book value of the S&P 500 going back to the 90s. That's that pink shaded area, just showing you here's what the value should be for the S&P 500. If you just look at book value, then if you want to add a little bit for like, okay, well, what should it be for, some kind of discounted cash flow technique, you can see it adds a sliver to it and where it should be in terms of valuation with that blue. And then the rest of it, I almost maybe a better word than hopes and dreams would almost be goodwill, right? I mean, is that kind of
blue sky? Blue
sky, like, but you can see the hopes and dreams component of valuation is like, it's more than 100% of the other two components of it there.
Well, it should never be negative, right? It just looks like it's extreme at this point, but it should never be negative because a company is more than just, a collection of assets, right? It's 1 + 1 should be more than 2.
Yeah.
If you're a successful capitalist business.
Right. But right now it's 1 + 1 is
395.
Yeah. So that's it. Like, look, I think what this means. So a couple of things just to sum this up. I do think that the big pensions in Europe are going to be looking at repatriating. On the heels of Liberation Day, they feel wronged. Canadians feel wronged, and they're talking about bringing money back home, and they have good reason to. For what they've got, they need capital to spend on developing their own military industrial complex, I guess, at this point. You look at U.S. policy, it's very uneven. You get a tweet one day that explains a new tariff for taking it away. It just becomes a little bit uncertainty. And I'm just saying, I think valuations don't justify it. And I think they're going to be looking to maybe look at their markets and certainly at cheaper valuations. I do think the currency debasement, inflation, the Fed abdicating their role, the price of gold and silver are telling you something. Do you want to speak to that real quickly on just our thoughts on the monetary system and currency debasement?
Yeah, so it very much looks like gold is being reintroduced into the global monetary system in one way, shape, or form, and that does not need to be.
And China is really kind of driving this.
That was
or part of it,
exactly
yeah.
what I was going to say. It does not need to be the U.S. Treasury or the Fed doing it, or even anyone in the Western world. It very much looks like the Chinese want that to happen. And honestly, it looks like a coordinated effort where both the United States and China are both way, and other Western democracies way over levered, and they're trying to devalue versus gold. And that's kind of why you're seeing some of this parabolic rise here. Now, where that ends, I don't know. Are we going to take a breather? I suspect it's going to be very volatile. And all the volatility we've seen, though, in like the last year and a half has been, positive volatility to the upside.
Yeah.
I do suspect that at some point we're going to get some of that negative volatility in there. But there's a lot of reasons to expect that trade might have legs. But I would expect a lot of volatility if you're in it.
And I think it's interesting, and I forgot I had this slide in here as well, but just, it's almost like the US government policy and industrial policy might be taking a page out of the Chinese playbook. If you're familiar with the term SOEs, or state-owned enterprises, where China really picks the national champions and the winners and losers. And we've decided in our infinite wisdom that maybe government is better at allocating capital. In any event, they've decided that, we might want to, have a government investment in some areas that we feel are critical. I know silver, Department of Interior is looking to have silver added as a critical mineral, which opens the doors for subsidies. If you think about silver, it's used in electronics, defense systems, data centers, AI.
And they could end up creating a strategic stockpile, kind of like how we have the strategic, was it petroleum reserve?
I don't think we refilled it.
Right. Well, it's definitely not full.
Yeah, but I did this analysis. I just kind of started thinking, like, look, this is amazing to me that the U.S. government, beginning in July, has announced they are taking stakes in these 4 companies. There's MP Materials. I believe that was the Department of Defense. It's the only rare earth mining and processing in the U.S. Turns out that rare earth minerals aren't really that rare. It's more the processing of them and the extraction of them.
Mining is a dirty business, right? And we've decided a long time ago that we were going to outsource that to China. And that has looked like a very big strategic blunder. But it's going to take decades to build up this type of mining capacity. And a lot of people are going to say, not in my backyard, and they won't want it. So it's going to be very interesting.
And then the smelting process of some of these metals is
just
like even worse, right? You don't want that. Certainly don't want that in wherever you might live in bucolic suburbia. You don't want that anywhere near you. But look, they're taking 10-15% stakes. Intel, that's another one. Their foundry business, like TSMC is the big, they're the top dog out there in terms of the foundry business. It's a very difficult business. Intel is very lousy at it. It's very unprofitable for them. They were going to try to spin it off, and the government said, no, we can't have that. We need to have that expertise here in the US. So they took this stake in order to prevent a spin-off of an unprofitable foundry business, which is the opposite of creative destruction. But that's where we're at. Lithium, largest, and I should say that Lithium Americas, it will be the largest lithium mine by 2028 in the Western Hemisphere. And then Trilogy Metals, lots of copper and zinc coming from there. So what I did, I figured, I want to look at the stock price of these companies going from where did the stock close on the day before the government announced their stake, and how has it performed since? You can see there, MP Materials up 60%, and versus the S&P 500 up 7.5%, Intel up 60%, Lithium Americas up 40%, and then Trilogy Metals up an eye-watering 215%. So you can look at it versus the S&P 500 or the sector index level. It is blowing it away. So maybe the lesson here is maybe you want to invest with the government in these with foresight. I know that what's his name? Commerce Secretary Lutnick. He's talked openly about Lockheed Martin. We might want to take a stake in Lockheed Martin. That's critical.
Yeah, these are not your old school Republicans, right?
Yeah.
It was Steve Bannon's talking about nationalizing industries as well. So this is not, libertarian type economics being practiced by any stretch.
So long term, not sure, brought to you, these guys, they're going to have a say in how they're managed. They'll have a say and they'll have a board seat and that kind of thing. Do I really want the same people who bring us the post office allocating capital within these companies? Probably not good over a long term, but for right now, it's like, hey, the government is putting their heft behind it. There's going to be subsidies. There's going to be most favored industry status granted upon them. So for right now,
it goes back to like, you don't have to like this or think it's good for the economy or America. You just have to recognize what is. And the fact that these 4 acquisitions have happened suggests to me that there'll be more in the future. And you should be paying close attention to that.
So sorry, I know we went very, very long here, but that's all I had on prepared slides and remarks. But happy to do any questions or ask us anything you want.
Well, John, Brandon, thank you so much for the presentation. You guys covered a lot of ground there, and it was fantastic information. I know our clients very much appreciate it. This is a great opportunity. If you have a question, please raise your hand. Either Chad or myself can unmute you. You can ask away. Anything is inbounds in terms of anything finance related. That's what we're here for. But I do have a question as our audience is kind of thinking about what they want to ask. So we do have some time here. Going back to that slide you had about concentration, and how the market is really concentrated in a handful of names. I think it's, we say 10 names that represent about 35% of the entire S&P index. And the narrative that's making its way through the media right now is, we haven't seen this since the beginning of the dot-com crash, right? Back in, was it 99? And I think it was the same kind of similar concentration. And we all know how that kind of played out. Which can be very alarming and alerting when people hear that, right? Is this going to happen? Is the market going to crash? I guess kind of a loaded question, but can we all agree that the companies that are in the top 10 back then versus now are a lot different in terms of the cash flows and the strength of those companies?
100%.
Your thoughts on that?
They're highly profitable companies. They're highly successful in their own right now, the here and now kind of thing. So for us, it's more a question about valuation, not about, hey, are these gonna, go belly up someday like pets.com or or toys.com kind of thing. They had no earnings, right? And they were doomed from the get-go.
There were a lot of companies in that .com, era that you would have loved to have owned if you could just, put it away in your closet or your desk drawer and not pay any attention to it. Amazon, Microsoft, and Microsoft by that time was a behemoth, right? The point of the slide that John had up there was actually, if you look at the PE ratio of NVIDIA, right? That's the eye-popping thing, is the PE ratio is 51, and never have we had in our history the largest company in the S&P 500 have anywhere near as large a PE ratio as that.
And by the way, there's somewhat of a circuitity to all these companies. Like they're selling to one another so that they can get ahead in this AI race. And,
NVIDIA takes $100 billion stake in OpenAI, and OpenAI then goes and buys NVIDIA chips. And then OpenAI then goes and buys a stake in AMD.
AMD, yeah.
Yeah, so it's I'm not entirely sure what to make of that, but it certainly got my antennas up.
Yeah, definitely something to keep an eye on for sure. I just want to make sure that our audience has that context, that it's not exactly the same.
So let me ask you guys this.
We compared it to the Nifty 50 as opposed to the .com, given the concentration. And it wasn't that the Nifty 50 weren't absolutely great companies. It's that they were overvalued.
Yeah.
Right. That's why that, crashed or whatever you want to call that. Whereas the .com was a different animal, exactly like you're saying. It was definitely a different animal.
So do you remember when I said, when we were talking about GDP and that now it's this massive CapEx that is starting to drive GDP growth? And by the way, these are in businesses that traditionally were considered capital light, right? Like you didn't need a ton of capital to, get, for Amazon or some of, Meta, that sort of thing. All of a sudden, they're spending huge on CapEx, something that they are not accustomed to doing in that space. And so my question would be, how much patience will the stock market have if they don't start monetizing some of this huge capital expenditure? And maybe they will, maybe it'll come quickly, but so far I think that the jury is still out on that, and it doesn't seem obvious that they've been able to move towards monetizing and justifying the capex.
And I think Nick's point that the Mag 7 or whatever you want to call them, Mag 6 or Big 10 or whatever Isaac's calling them, they are hugely cash flow positive, right? And all of that cash flow for the past, say, 10 years was going into share buybacks, or at least majority of it. And now it's going into capex. Could that have an impact on the price? You would think it would. Right. Instead of directing that to buying back your shares, you're doing it for capex,
Investing in the company.
And it's not to say that you shouldn't be reinvesting in the company. It just means that maybe there could be a potentially sizable pullback in between when this capex is paid out and when it's monetized.
Fair point. Yes. Hopefully it's a good investment, right? It's got to pay off. Yeah.
Yeah.
Good. Well, I think we're at the bottom of the hour. Once again, I want to thank you guys for participating in our event today. I know you guys are coming to us from Michigan, Detroit Lions country. So hopefully the Lions can bounce back after that rough one against the Chiefs this week. But best of luck to the Lions as long as they're not playing the Niners. But no, I'm just teasing. But thanks again for joining us. I know Chad, you want to jump in and kind of wrap us up?
Yeah. So I'll echo that, John, Brandon, Isaac. Thank you again for your partnership and your time. Everybody on the call today, appreciate you making a little bit of time out of your morning to join us as we talk about the markets prior and ahead. We do have our next webinar will be November 6th. We'll be rolling up the sleeves on estate planning. So keep your eye on that emails for invitations for our next webinar, as well as our kind of year-end holiday open house in December as well. So we're already talking about December events. Crazy how fast this year has flown, but we appreciate you guys joining us for events throughout the year and look forward to the upcoming events as well. If you have any other questions, questions we didn't get to, things that are on your mind, that's what we're here for. So please don't ever hesitate to give us a call, send us an email, if there's anything that's come up that we can help with. So with that, thank you again, everybody, for your time. We'll be chatting soon, and I hope you all have a wonderful rest of your day.
Thanks, everybody.
Thank you.
You.
Thanks, everyone.